Let's start by taking a look at the foundations of life insurance. Purpose, policy elements, and life insurance basics. What is the primary purpose of life insurance? Is it A, to provide financial protection to beneficiaries? B, to accumulate savings for retirement? C, to offer tax-free investment opportunities? Or D, to cover medical expenses? The answer is A, to provide financial protection to beneficiaries. Life insurance is primarily designed to provide financial protection to beneficiaries in the event of the insured's death. It ensures that dependents have financial support to cover expenses and maintain their standard of living. John is considering purchasing a life insurance policy to ensure his family is financially secure if he passes away. What type of policy element should he focus on to determine the amount of coverage needed? Is it A, premium amount? B, policy term? C, face amount? Or D, cash value? The answer is C, face amount. The face amount is the death benefit paid to beneficiaries. John should focus on this element to ensure it meets his family's financial needs.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Term versus permanent life. Key distinctions. Which type of life insurance policy typically offers a cash value component that can be borrowed against? Is it A, term life insurance? B, accidental death insurance? C, permanent life insurance? Or D, group life insurance? The answer is C, permanent life insurance. Why this question may seem a bit tricky: term life insurance does not accumulate cash value, while permanent life insurance, such as whole or universal life, does. The cash value can be borrowed against, which is a key feature of permanent policies. Term life insurance. Level term, decreasing term, yearly renewable term. What is a key feature of a level term life insurance policy? Is it A, the death benefit remains the same throughout the term? B, the premium decreases each year? C, the death benefit decreases over time? Or D, the policy can be renewed without proof of insurability? The answer is A, the death benefit remains the same throughout the term. Level term life insurance maintains the same death benefit throughout the policy term, providing consistent coverage for the insured. John has a yearly renewable term life insurance policy. What happens to his premiums as he renews his policy each year? Is it A, his premiums decrease each year? B, his premiums remain the same each year? C, his premiums are refunded at the end of the term? Or D, his premiums increase each year? The answer is D, his premiums increase each year. Yearly renewable term policies typically have increasing premiums as the insured ages, reflecting the higher risk of insuring an older individual. Advantages, disadvantages, and when it fits. What is a potential disadvantage of term life insurance that might be overlooked? Is it A, it provides lifelong coverage? B, it accumulates cash value over time? C, it does not build cash value? Or D, premiums decrease over time? The answer is C, it does not build cash value. Why this question may seem a bit tricky: term life insurance is often seen as affordable, but the lack of cash value can be a disadvantage if policyholders expect a return on premiums paid.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Whole life, ordinary life. Features: fixed premium, cash value growth, participating versus non-participating. What is a key feature of a participating whole life insurance policy? Is it A, fixed cash value growth, B, payment of dividends, C, variable premium payments, or D, no cash value accumulation? The answer is B, payment of dividends. Participating whole life insurance policies pay dividends to policyholders, which can be used in various ways, such as purchasing additional coverage or reducing premiums. John has a whole life insurance policy with fixed premiums and is considering whether it is participating or non-participating. What feature should he look for to determine this? Is it A, fixed premium payments, B, guaranteed cash value growth, C, dividend payments, or D, variable death benefit? The answer is C, dividend payments. John should check if his policy pays dividends. Participating policies pay dividends, while non-participating policies do not. Variations: limited pay, single premium, continuous pay. Which type of whole life insurance policy requires the policyholder to pay premiums for the entire duration of their life? Is it A, single premium, B, limited pay, C, continuous pay, or D, ordinary life? The answer is C, continuous pay. Why this question may seem a bit tricky. The term continuous pay might be confused with limited pay, but continuous pay specifically refers to paying premiums for life, unlike limited pay, which has a set period. Universal life and flexible premium policies. Universal life basics, flexible premiums, cost of insurance charges. What is a key feature of universal life insurance that differentiates it from whole life insurance? Is it A, guaranteed cash value growth, B, flexible premiums, C, fixed death benefit, or D, dividend payments? The answer is B, flexible premiums. Universal life insurance offers flexible premiums, allowing policyholders to adjust their payments and coverage amounts, unlike whole life insurance, which has fixed premiums. How does the cost of insurance charges in a universal life policy typically affect the policy's cash value? Is it A, they increase the cash value, B, they have no effect on cash value, C, they reduce the cash value, or D, they are added to the death benefit? The answer is C, they reduce the cash value. Why this question may seem a bit tricky. Cost of insurance charges are deducted from the policy's cash value, which can reduce the cash value if not offset by sufficient premium payments or interest earnings. Indexed universal life, index crediting, caps, floors, and risks. What is the primary purpose of a cap in an indexed universal life insurance policy? Is it A, to ensure a minimum return, B, to limit the maximum interest credited, C, to eliminate investment risk, or D, to guarantee a fixed interest rate? The answer is B, to limit the maximum interest credited. A cap limits the maximum interest credited to the policy, protecting the insurer from excessive payouts during high market returns. Sarah has an indexed universal life policy with a cap of 10% and a floor of 1%. If the index performs at 12% this year, how much interest will be credited to her policy? Is it A, 12%, B, 1%, C, 10%, or D, 0%? The answer is C, 10%. The cap limits the interest credited to 10% even though the index performed at 12%. Variable and variable universal life. Variable life, investment risk in separate accounts. What is a primary risk associated with investing in a variable life insurance policy's separate account? Is it A, guaranteed returns, B, fixed interest rates, C, investment risk, or D, stable cash value? The answer is C, investment risk. The primary risk is investment risk, as the policyholder bears the risk of the underlying investments in the separate account, which can fluctuate in value. Alex has invested in a variable life insurance policy. If the separate account's investments perform poorly, what impact will this have on Alex's policy? Is it A, decrease in cash value, B, increase in death benefit, C, fixed premium payments, or D, guaranteed cash value? The answer is A, decrease in cash value. Poor investment performance can lead to a decrease in the cash value of the policy, affecting the overall benefits and potentially requiring additional premiums. Variable universal life, combining flexibility plus investment risk. What is a key feature of variable universal life insurance that distinguishes it from traditional whole life insurance? Is it A, guaranteed cash value growth, B, investment options for cash value, C, fixed premium payments, or D, lifetime coverage without investment risk? The answer is B, investment options for cash value. Variable universal life insurance allows policyholders to invest the cash value in various sub-accounts, offering potential for higher returns but also increased risk. Alex has a variable universal life insurance policy and wants to increase the death benefit. What must Alex consider regarding the policy's cash value? Is it A, higher premiums or sufficient cash value, B, guaranteed cash value growth, C, fixed premium payments, or D, no impact on investment options? The answer is A, higher premiums or sufficient cash value. Increasing the death benefit may require higher premiums or a sufficient cash value to cover the cost, impacting the policy's investment performance. Scenario application and policy selection. Given client goals /budget/risk tolerance, choose best life policy. What type of life insurance policy provides coverage for a specific period and typically has lower premiums? Is it A, term life insurance, B, whole life insurance, C, universal life insurance, or D, variable life insurance? The answer is A, term life insurance. Term life insurance provides coverage for a set period and usually has lower premiums compared to whole or universal life insurance. A client wants a policy that builds cash value and offers flexible premiums. Which type of life insurance should they consider? Is it A, term life insurance, B, whole life insurance, C, universal life insurance, or D, variable life insurance? The answer is C, universal life insurance. Universal life insurance allows for cash value accumulation and flexible premium payments, making it suitable for clients seeking these features. Which life insurance policy type is most suitable for someone with a low risk tolerance seeking guaranteed cash value growth? Is it A, term life insurance, B, whole life insurance, C, universal life insurance, or D, variable life insurance? The answer is B, whole life insurance. Why this question may seem a bit tricky. Whole life insurance offers guaranteed cash value growth, unlike universal or variable life insurance, which may involve investment risks.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.